Hi, welcome to the session on business valuation. We've been looking forward to this session because it's quite integral to most of the roles we perform as forensic accountants, doesn't it? So what is it that we'll really be talking about? I'll give you the background to why business valuations come up so frequently in the work of a forensic accountant. It's very important. Why? Why do we need to be able to do this? And then we obviously have to be able to apply the relevant business valuation techniques, methods themselves, because we may be either valuing a firm or we may be checking other accountant or finance professionals' valuations of businesses. So we need to be able to use the techniques ourselves. Right, so first questions first. Why are business valuations very important in our lives as forensic accountants? Well, because most of the litigation that goes on in business that we may be involved in tend to revolve around the values of businesses as going concerns. So it may be in the context of a matrimonial dispute, investors disagreeing, commercial damages, or if economic losses, as we mentioned in the previous lectures, do come up. And then we may also be looking at various bankruptcies and dissolutions of firms or partnerships. So it's quite common. We may also have instances where a firm is being listed or has been listed, or we may have mergers and demergers and changes in ownership. Right? These may result in various forms of disputes about the value of the business involved. And again, if both parties cannot agree, they will need an independent accountant to help them resolve it. Sometimes these disputes have ended up in court, and of course, the court might need you to help it in ascertaining what the reasonable value of the firm involved is. We may also talk about tax issues, and I think in your tax modules you would have come across it if you're taking the tax module. If you're not taking the tax module, it doesn't matter at this stage. Right? There are various reasons why knowing the value of a firm can have tax implications. So for now, what we need to get on with is we need to get our heads around how you go about determining the value of a business in our lives as forensic accountants. You will have to appreciate that valuation is not simply a scientific activity. You're not just looking for facts and adding numbers together, because there are huge ranges of estimates or judgments that will come up. Okay, so it is as much a scientific exercise as it is judgments, or if you like, using your intuition to translate your understanding of the firm into figures. So it is, if I say it again, it is as much scientific as it is an estimate, right? So you're not really talking about facts all the time. You have to interpret, analyze, and translate your understanding of the strategic issues of a firm or an entity into figures. So you're interpreting as much as you're drawing on facts. Okay, so there could be different opinions, and this is where the disputes could arise from. Apart from listed firms that may have an open market value, you may have a lot of privately owned entities or unlisted businesses that need valuation. And there you've got all the data, and you have to sift through the data, pick what is relevant, and try to estimate what the reasonable value of the firm is. Whenever we come up with estimates, or judgments or values, then you can see that opinions may differ, and that is why you may be there to bring some kind of fair degree of certainty into the debate. Okay, so essentially, you're going to look at whatever is relevant information. So these may be, business-related information that are not quantified in monetary terms. So how the business is organized, what activity it does, who owns it, where are they located, what are the industry trends, how is the market playing out or panning out, are there long-term ongoing economic, macroeconomic trends that would impact on the value of the firm. So these are quite broad and generic, but you may also have, or you will have, some very specific data that falls within the remit of the accounting function, like data from financial statements, and so on and so forth. And you have to look at all that data, pick what is relevant, and translate it into a value for the firm. Interesting, isn't it? So how do you go about it? Well, as you can imagine, there are various techniques and approaches to go about it. But the latitude, the range of opinions will be very wide, right? Because you may draw on historic data, you may create forecasts, or you may even come up with projections. The issue at stake here is, if you're playing with historic data, then there is certainty. Usually we would be able to accept that if financial statements have been audited and signed off, then let's agree that they are facts. Right? So we can kind of agree very easily when we come to historic data. But the historic data has its own disadvantages, because when you're looking at the value of a firm, you're not just looking back, you're looking at the value in terms of future cash flows that the firm can generate. So the past may not be the perfect guide to what the future will be. Okay, so that's something that people may disagree about. If you want certainty, you use a historic data, but the historic data might not tell you the full picture. Right? It might not tell you everything there is to know about how valuable the firm is likely to be in the future. Well, again, we know that the accounting data does not record or present all the value relevant information, isn't it? Because the accounting rules usually are very historical in their approach, and they are very conservative because of the need to be truthful, right? You have to accept that recognition rules do not permit the recognition of certain assets or certain gains, for example. So we may be looking at goodwill, the commonest example there, internally generated goodwill, or intangible assets that are not separable from the other assets of the business may not have been recognized on the statement of financial position. But if we are valuing a firm that is in the knowledge sector, where a lot of the drivers of its value are not tangible assets, then you can accept that even though the historical financial statements are factual, they may not be recording, or they may not be reporting all the value relevant information. So we may look at historics, but we will have to turn our eyes quickly and start looking at forecasts or projections. There you go. And the moment you start looking at forecasts and projections, there could be a lot of disagreements, right? What are the likely outcomes for as far as the future is concerned? So that's what we are doing. We're trying to draw on as much facts as we can, but we're also trying to come up with reasonable estimates and projections. So the methods that I would like you to remember at this stage are the net assets based valuation method, and then should be able to look at some income or earnings based methods, and then we will look at market based methods. So what I'll do now is, I think the best way to explain this will be to use examples. You surely have the book, so you would be reading and getting the background information. What I'm going to do now is I'm going to flick through the slides and show you how to use these techniques by using these examples. Right? The Excel sheet will be on Moodle, of course. So a bit of background here. You can see the asset-based valuation method, or sometimes called the net assets method. It's really based on the historic data. Right? So we pick the financial statements and we use our basic accounting equation to subtract the liabilities from the assets, and that will give us the net assets or the value of the firm. There are some entities, or there are instances where this method will be the most appropriate. Can you guess what that instance will be? Well, not long ago I did say that the accounts may not recognize all the assets and liabilities of the entity. But if the nature of the industry that we're talking about and the financial statements that will result, because they are based on the accounting standards which drive us to capture close market values, then it is very likely that the financial statements or the statement of financial position of that entity will be very close to current values. Let me say that again. So for some industries where assets, liabilities, revenues, gains, and all that, because of the accounting standards, if these are recognized at fair values, then we can be very certain that the assets and liabilities will give us equity values that are almost reasonable estimates of the value of the firm. So let's see an example here. We have a firm that specializes in commercial properties. We've been given excerpts of the statement of financial position, and the task is, can we value this firm? Well, it will be very straightforward. You can see here we would add the assets together, we will add the liabilities together, and we will subtract the liabilities from the assets. What do you do with an impairment here? Well, the impairment here is telling you that the assets here, normally the non-current assets, have been recognized at a value that is very different from its recoverable amount. We saw that in our previous spot the error activity. So if that's the case, then we need to subtract the impairment loss from the values of the assets. Okay, so we would have otherwise had 420. We have to subtract 8 from it and have 412. Okay, so let me just take you through that. So we come into our spreadsheet here. And we calculating the net assets base value for this firm. Where am I? Good. So the non-current assets are 400. The current assets are 20. So we have our total assets. Just add them together. Yeah. So we add our two assets there. And we subtract from that the values of our liabilities, so non-current liabilities and our current liabilities. That would otherwise have given us 240, right? But the value of the firm will be the net assets minus the impairment loss, right? So we subtract that impairment loss from the net assets, and that will be the value of the firm. And we are a bit happy because these assets have all been recognized using the fair values approach, right? Because the firm is in the investment sector where accounting standards expect us to regularly value the assets for impairment. So these values are quite close to what their readily disposable market values will be. So it could be easily agreeable that the value of the firm will be around 232 on the basis of the figures provided. So that was that. Why is the net asset base value probably acceptable? I think we've said that because it's a bit likely that the assets and liabilities are recognized at fair value, and probably a bit unlikely that we will have a lot of intangibles or unrecognized assets and liabilities. Of course, that is a matter of fact. We will have to check to see if that is the case. Okay, let's move on then to the next method. So the next method is a discounted cash flow approach. Very popular approach as far as your studies are concerned. And if you remember what this is all about, this is about estimating how much value the business will be creating in the future. Okay, so to work out how much money the firm would make in the future, we will have to, of course, forecast the future inflows and the future outflows of cash. We are not really going to do that here for now. So we're just leaving that out for your subsequent modules. But what we're saying is if we knew how much cash flows will be made in the future, we can then discount them to their present value, right? Discounting because of the time value of money. So we forecast a set of future cash flows and we discount them at an appropriate cost of capital. I think you saw that in the previous Spot the Error activity as well. So let me take you through this. We are investigating because somebody has valued a firm and they came up with a value of 7,277.45. There are disputes, so we have been called upon to come and check to see if this is a reasonable estimate. We've been given the free cash flow at a given point in time. So the free cash flow is a net cash flow, right? The outflows of cash have been taken away from the inflows of cash. So whatever is left is what the owners of the firm could have taken out. Okay, so free cash flow means cash that the owners could have taken out. And therefore, we're going to project these free cash flows to the future and then discount them to their present value. Okay, to do that, we have to use the dividend valuation model, DVM, remember? Okay, so we would need to know what the growth rates are. So if the firm has 820 million now, how likely is it to grow? At what rate will it be growing? That is the growth rate. And we also need to know the cost of equity, or if you like, the cost of capital. And we would just plug these figures into the formula, and the formula will give us the discounted cash flows. Ooh, that sounds simpler than it is in fact. So let's go over to the spreadsheet and I'll show you how we would check to see if this figure of 7,277.45 is correct. We will do the first thing of forecasting. So I've got the current free cash flow here, 820. We are told in the question there, that it is estimated that for 3 years, the firm's cash flows will be growing at 3%. And then after 3 years, for the long term, the cash flows will be growing at 2%. Right. So how do we use that? So we'll be forecasting what the first 3 years set of cash flows will be. So the first 3 years, remember, the cash flows will be growing at 3%. So we will estimate that. And then we'll have to estimate what the long-term cash flows will be. That will be growing at 2%, it said. Okay. So I've got my 3% and my 2%. It's very straightforward. So I pick my current cash flow and I multiply it by 1 plus the growth rate. So it's going to grow at 3%. I'm just adding 3% on top of the 820. Right. So I do that. Because I'm using Excel, I'm just going to use the absolute referencing so that I can just drag the cash flows along. So for 3 years here, for each year, you can see the previous year's cash flow has been multiplied by 1 plus 3%. Right, so I've done that for 3 years. Okay. And then after 3 years, we were told that the cash flows were going to grow in the long term for 2 years into the perpetuity. Okay, so what do? We're going to calculate the cash flows from the end of year 3 to forever. Why? Because the firm is assumed to be a going concern. Remember that accounting concept? Going concern means the firm is going to continue at its current rate of activity, and there are no signs that it's going to significantly reduce its scope of activity, or, if you like, fold up. Okay, so we're going to assume that the firm is going to grow perpetually at 2%. And to work out the sum of the cash flows from the end of year 3 to forever, we use a dividend valuation model, the DVM, or the Gordon's growth approach. So that says that we should multiply our cash flow, CF, multiply the cash flow by 1 plus the growth rate. So our long-term growth rate is 2%. And we should divide that by the cost of equity divide that by cost of equity minus the growth rate. Oops. So we know our long-term growth rate. We don't know our cost of capital. So that formula there tells us that we need a cost of capital. And we will be able to calculate the cost of capital. If you look at the question gave us data on the risk-free rate of return, the beta, and the market return. That should remind you that you'll be able to calculate the cost of equity using the capital asset pricing model. So apart from the dividend valuation model, you also need to remember the capital asset pricing model formula, because it tells you what figures to pick in estimating the cost of capital or the cost of equity. So it says we should pick the risk-free rate of return. Where is it? Risk-free rate of return. Sorry, picked it from the wrong place. Risk-free rate of return is here, 3%. We should add to that the beta there, multiply by the market return. Market return is down there. Market return minus the risk-free rate of return. Okay. So we can see that's what the formula said. Risk-free rate of return plus beta times market return minus risk-free rate of return. And that's what we've just done. If I just do it again, so that you can pick it up if you haven't. So risk-free rate of return plus beta times market return minus risk-free rate of return. Good. So let me just highlight that. That is our cost of equity. And we need that to work out the terminal value. So this total of future cash flows from the end of year 3 to forever is called the terminal value. All right, so the terminal value, to calculate that, we need to pick the previous cash flow multiplied by 1 plus the growth rate, the long-term growth rate of 2%. We divide that by the cost of equity that we just calculated minus the growth rate, the long-term growth rate, the same long-term growth rate. Right. So that is a huge figure. That is about 7,745, which is the total of the free cash flows from the end of year 3 to forever. So we've got our free cash flows here. We've got our future free cash flows. Let's give them a new color of green, maybe. But this is 1 year away, 2 years, 3 years. And remember, this starts from the end of year 3 to forever. So we need to discount them. We need to bring them to their present value. And how do you discount? You discount by, you have a future value, FV, you divide it by 1 plus your cost of capital raised to the power n being the number of years, right? But remember, I don't like that. I don't like dividing. I think multiplying is quicker. So I tend to do the future value multiplied by 1 plus your cost of capital raised to the power negative time. Okay, so that's what we're going to do now. We pick the future cash flows, so that we multiply it by 1 plus the cost of capital, and we raise that to the power of negative time. So you can see I've got a time here, year 1, year 2, year 3. And the terminal value is also at year 3 because it starts at the end of year 3, right? Or if you like, the beginning of year 4. Okay, so I'm just going to fix the cost of capital here. I'm going to use absolute referencing so that I can just drag it along. Okay, so I just drag it for each of the future cash flows. So you can see each of the future cash flows has been multiplied by a 1 plus the cost of capital raised to the power negative time. Okay, and that gives us smaller sums. So your quickest check, your sanity check, is to check that when you've discounted, the figures you get are smaller than the future values. And then we just add them together. We just add up all our discounted future cash flows like so. And that should be the value of the firm. Okay, so I hope you'll be able to go through this and get it right. So let's just check to see if the analyst who did the original work did a good job. Did they? You can see the figure. Yeah, it adds up. So if these inputs are right, then they've applied the technique correctly, right? But then we go on, identify any 3 assumptions or estimates in the valuation of the firm that are questionable. So if you were involved in this dispute resolution, what are some of the figures that you would question? Right? You would need a bit more clarification on to really accept the figures that have come out. Remember the old saying that garbage in, garbage out, right? So we're not saying that this is correct, right? The correctness of the figure here, what we've just got there, the correctness of that figure depends on the inputs. And you can see there have been a lot of estimates that have gone into this. For example, how did they estimate the initial growth rate? That one. What's the basis of that? Does that fit the past trends and the future trends? How did they estimate the long-term growth rate? I think I've told you before in the previous spot the error activity that this long-term growth rate sometimes is calculated using Gordon's G as, do you remember? The profit retention ratio multiplied by the cost of equity. But how do they calculate this long-term growth rate? Again, is it reasonable? If we look at the market trends, does it add up? This risk-free rate of return is a bit bigger now. This is the government benchmark gilt rate. Right? So if you have a government bond, would you be earning 3% now? No, that's too high. Right? So probably that is questionable. How do they calculate the beta? If this firm is not listed, then as you can see, they've looked at the target firm and they are adopting the beta of that target firm. How did they select that firm? Is it really similar to this firm? Did they make any adjustments to the beta? And so on and so forth. I mean, is the market return really 12%? How did they go about it? So all we're saying is, as a forensic accountant, you'll be looking at every one of these key inputs, and you'll be checking the data that led to that estimate before you accept the outcome. But for now, we've done the numbers and we ascertain that the numbers do add up. So we've done the net assets valuation method. We've done the discounted cash flow approach. We move on. And you probably will understand why for this week, there wouldn't be, for this topic, I should say, there wouldn't be a separate seminar. And because what I've done is I've combined the tasks that we would have done in the seminar into this session. So once you have gone through this and you're happy with your figures, that should be fine. We've got two more illustrations. So let's go back to the slides. The next one is where you're capitalizing earnings in the valuation of a firm. This is quite important when you're looking at small and medium-sized businesses who may not have that much data that would be available if you were looking at a larger firm. So for most SMEs, it is very common that when these firms have been valued, they've been valued using the accounting data in the estimation of what we call the maintainable earnings or sustainable earnings, right? How much profit is it very likely that a firm would make? And we would then capitalize. We would just multiply that maintainable profit by a certain number. That number representing the set of years' profits that whoever is buying or taking over the firm would be paying for. So if we come up with a figure of 4, then what we are effectively saying is this firm that you're valuing or that you're buying will be able to make some super profits or some additional profits of X amount, and you're paying 3 times or 4 times or 5 times that amount of profit because you'll be owning the firm forever. Okay, well, that's a good brief introduction, I think. So now let's look at a private firm that we are valuing here. The industry average capitalization rate is 6. So that means once we found the earnings before interest, tax, depreciation, and amortization, EBITDA, right? After we've calculated that profit, we will multiply it by 6, and that will be the figure that represents the maintainable profits that represents the value of a firm. So we've been given this data here. We've been given the profit before tax of 245. Let's just go there. Go into our Excel. So 245,000 it was. And we've been given depreciation of 23,500. 23,500. We've been given interests of how much? Let's see, 19,200. 19,200. And the director's earnings of 45. I'm just picking these the data so that we can play with it. Okay. And then we have emoluments otherwise of 87,000. Okay. So what happens here is this is our profit before tax. But what we want the earnings before interest, tax, depreciation, and amortization. If you remember the format of your profit or loss, the operating profit effectively is what we're looking for, right? So to revert back to the operating profit or the profit before we've deducted interest, tax, depreciation, and amortization, we need to add back the depreciation, don't we? So let's do that. So we'll pick the profit before tax. We need to add back depreciation. We need to add back the interest. And the question also said that there is going to be a change in management structure, isn't it? So somebody is leaving, right? So profits are shared equally. We've got directors' current remuneration, but the idea is if people are directors, then usually their remuneration in terms of wages and salaries and all that are not the market rate. Okay, they're not the market rate because they have other ways of taking money out of the business in terms of maybe paying themselves dividends. So what we're saying is it would not be right if we just take the reported director's remuneration. Why? Because in real life, if this person, this executive, was not a director, then they would have been taking out 87 instead of 45. So we need to adjust this year, right? We need to make a change. We have to pretend as if this person is not there, right? and account for what the true market situation would have been. So we would be adding back the 45, which was the expense that was deducted in the calculation of the profit before tax, and we would rather take away what the market emolument or remuneration would have been, which is 87k. Let us go back there and we will add back the existing director's remuneration and instead subtract the market rate of 87k. So not too different, but you can see maintainable, or let's say revised earnings is 245,700. Let's make sure we added everything. So add, subtract. Good. And then simply the maintainable EBITDA, that will be the base of value in this term, will be the revised earnings times the factor of 6, isn't it? Of course, the key question is 6 right? I mean, usually you would be looking at some trade publications or industry publications or trends in the industry to ascertain if that's a right capitalization rate. But otherwise, that would have given us the value of the firm based on the maintainable earnings. So you can see it's all about being able to calculate the maintainable earnings, adding back the expenses and multiplying by the relevant factor. Finally, let's look at the final example. So the final example is where you have to value on the basis of a benchmark again, right? Benchmark again. This time the benchmark is not EBITDA. The benchmark is the PE ratio. Tiny story. Couples who own a business are falling out. We'll be talking about matrimonial cases in our final lecture. But they've fallen out and you need to value the firm that they own. And this firm is not listed. So you have to look at a benchmark, and the benchmark that you have picked or that is suitable is the benchmark of other firms that have been sold that are similar to yours. And you've picked the price to earnings ratio before tax of 8. Okay. You have also been been told that for small businesses, there usually are discounts. So if you read your book, you would come across this idea that small firms have a liquidity discount, which is an adjustment that is made to the PE factor because of their size. Effectively, if you had a bigger listed entity, there would be probably less hassle in selling it. But if you have a small entity, then the risks are higher and people sometimes don't even trust that the data is all what it should be. So there is a discount, like a reduction in the PE, and the range you've been told is between 20 and 30%. The tax rate for this firm is 18%, let's assume, and the profit before tax is 8,546,000. So let's just go there and see. Right, so this is how we'll set ourselves up. We have the earnings before tax, 8,546,000. You may be wondering, why have I got 3 columns here? Well, I've got 3 columns because remember, we have a range for our discount. The discount could be 20% or 30%. Or in fact, we could have an average, isn't it? So let's have an average of 20 and 30. You might be saying, why did you not just do it mentally? Yeah, I could have, but sometimes you can have a good range, and therefore it's better to go about taking an average there. So what we do is, we know the profit before tax, right? We need to calculate the profit after tax. So if it is a profit, we'll just multiply it then by 1 minus the tax rate, isn't it? So 1 minus the tax rate. If I just fix it so that I can just drag it because I'm lazy to get the same figure. Okay, so that's the idea, and we need to discount the PE factor of 8. We need to discount it by 20% on the low side, or 30% on the high side, or 25% as a median. So let's just do that. So this PE factor, will just be multiplying it by 1 minus each of the discount factors. Okay, so if I just fix that again, just to keep it there, then the relevant PE factor that we should use could range between 6.4 or 6. Okay, and then on that basis, the value of a firm, if you're using the PE method, is the PE multiplied by the earnings. So that's very straightforward. We pick the earnings after tax and we multiply it by the relevant PE. Okay, which means that the value of this firm could range between 4.48941 or 3.924323. And of course, you know, as the question says there, right, there might be, a debate. There will be, if you like, a mini dispute about the figures here, and we have to kind of look at what is reasonable, especially the discount. Which discount rate should be applied? Should it be as low as 20% or as high as 30%? And you'll be looking at how closely the target firm, the firm you're valuing, matches the average in the industry to come up with a reasonable estimate. But if you have to do it, to the courts, it will be good to show the range of all these calculations and justify the choice that you have made. I think this has been a very long one, but you probably have got a good understanding of why business valuations are very important, and you've seen different techniques. We've seen the net assets method, we've seen the discounted cash flow method, we've seen various forms of capitalization of earnings. We saw, first of all, the maintainable earnings after we adjusted the accounting profits, and we have also seen the price earnings ratio method. So go through this, and this, trust me, should be enough for business valuations. This will be very important in your assessment. You should be able to check what other people have done with these valuation techniques. And I hope to see you very soon.